Thank you all friends. Thank you all friends for taking your time out on a Saturday morning and gearing up for getting some insights about the markets. We all know markets have been volatile for last 1.5 years to 2 years due to global events, due to geopolitical tensions and interest rates hike. Due to all these major reasons, we are seeing that almost it has been volatile. So what needs to be done? Most important thing for all of us is to manage our emotions, and that is all typically we most of us get carried away by a lot of, let's say, news, social media stuffs, etc., and because of which sometimes we don't stick to our financial plans, and we take decisions based upon our behavior. So considering that, I thought behavior finance, or maybe how to manage our behavior, would be the most apt topic at this point of time. And I'm really humble that we have Mr. Manish out here. Manish is the joint president and national sales head at Kotak AMC. So and special thanks to Sachin sir and Mohit for arranging and availing us the time for Manish. So Manish, again, I've heard you a number of times. The one thing which I like about you is simplicity. You make things so simple and you explain, I would say, in a very simplified manner, even the complex term, with a lot of stories and analogies. So I think, a lot of us typically get carried away by some stories in social media, WhatsApp, and today, all of us want you to listen some stories so that how we can manage our emotions and how we can take this forward from here. So over to you, Manish sir. Thank you.
Yeah, Saurabh, thank you so much, and good morning, everyone. And thank you for taking time out of your schedule to be here with us. And when Saurabh and we were chatting about what topics should we be talking about, and he said, no, what do you think this year the markets are going to look like? And when we make a market presentation, the first slide that we have started to put is saying, be ready for volatility. And I said, if volatility is going to be there, then I said, Saurabh, considering the fact that a lot of your investors are professionals who are basically there is a source of regular income because of the kind of profession that they're part of, salary. So I'm sure there must be like SIPs, STPs which are currently going through. ऐसे इस साल आप है ना लोगों का खाली इमोशन मैनेज कर लो, इन्वेस्टमेंट्स की चिंता मत करो, let that journey continue. And I think that is what we wanted to just sort of highlight in this particular discussion that we have. And to begin with, I last Saturday in the Times of India in Speaking Tree, there was this one story that appeared, and it was a story about this one particular bull who was probably the most strongest bull in the world, and he could fight anybody. And what happened was that there was so much of exuberance and confidence in him that he started to go and challenge people. So he went and sort of challenged the ocean and told the ocean that, come fight with me. I want to prove to everybody that I am the strongest person on earth. And the ocean said that, listen, I am very calm. I very rarely get very angry. And I don't think I'm very old and frail. I don't think I have the courage in me to fight you anymore. So, please excuse me. I am willing to concede defeat against you. He's saying, okay, then, who is it that I can go to who can, take up my challenge? And he was told to go and I think meet the monkey god. And before he could hear the entire story, before he could complete to tell him that, listen, but you need to be careful. This bull started to charge and went up to the Himalayas. And he went and challenged this particular god. And God very calmly told him, you better think twice before what you're asking to do. And he said, no, nothing doing. I have to fight against you. And he told him something in a very derogative manner. And that God got so angry that the God fought him and ripped the bull apart. And the bull died. So what the last para of that speaking tree was very, very interesting. He's saying there was so much of negativity and so much of, I would say, negative emotions, which was filled in the bull that sort of just blinded him completely. And the conclusion of that article was to say that even in today's world, we also probably can get influenced by a lot of news and chatter around you. And he's saying that the bull in this modern world is actually social media. And if you can stay out of the social media, then you probably will not make the kind of mistakes which that particular bull made in the historic times. So that was what the gist of that story was. So taking our discussion forward, uh, okay. So so basically there is this saying, that making money is tough, but growing money is tougher, and that's the reality. And because the fact of the matter is, and many a times, we've seen that, and which I'll conclude, that we actually make a lot of effort to see to it that we don't make that kind of wealth that actually which we could probably look at making. Now, there is this one Dalabar study which gets conducted every year, and I'm sure you probably seen these slides in multiple presentations, which says that an investor's return and the market returns have never been the same. So this study, which was conducted from 1993 to 2022, as far as the average equity investors' returns versus the indexes there in the US, and it's very clearly visible that over such long periods of time, where an S&P 500 gave investor about a 9.65% of compounding returns, the average investor has actually made only 6.8. So what does this basically say? That हर इन्वेस्टर या तो गलत टाइम पे ट्रेन में चढ़ा है और गलत टाइम पे ट्रेन से उतर गया है. And that is the reason why his returns and the market returns are never been the same. But if someone had just continued to keep riding this story, obviously the situation or the story over here would have been different. Now, obviously, as I said, Nifty is going to be extremely volatile. And this chart is for the period like April 1, 2022 till March 28, almost in 1 year. And if you see the volatility in the Nifty 50, almost about 118 times it has given a positive change. 128 times actually it has been negative. So just for a lay investor or an investor like yourself and myself, I mean, obviously, if we were to keep on looking at this chart on a daily basis, this probably is worse than the ECG of ours also. मतलब अगर आप आज जाके अपना stress test करेंगे तो शायद हमारा heart beat इससे better रहेगा. But the fact of the matter है ये chart देखेंगे तो definitely दिल की धड़कनें बढ़ने लगती हैं. So and you see, at the end of the day, we're all human. We go through multiple emotions. So obviously, when the markets are doing extremely well, it's very normal. There is euphorism because when we look at our statements, portfolio statements, it is looking very interesting. Sometimes it can lead to overconfidence. This is the one-way street. मतलब या तो अभी मतलब return multiplier तो ऐसे ही बढ़ते रहेगा. Chances are there that we may in fact even end up taking excessive risk. Maybe at times Saurabh bhai might have come and told you कि sir आपके asset allocation के हिसाब से equity आपका बढ़ गया है, थोड़ा कम करना चाहिए हमें. And the chances are that we as investors would have probably gone back and told our advisors that no, the party is still continuing. Let it go on now. Why unnecessary should we look at booking profits? The same thing we do in the reverse also. When the markets obviously come down, there is stress because we can't see losses. Sometimes we end up taking wrong decisions. In that point of time, if Saurabh would have come and asked us that time has come to add equity, chances are that 9 out of 10 times we will tell him that no, hold on. I think the worst is yet to come. So this is the kind of emotions we typically tend to, go through as humans, even when it comes to a stock market behavior. So how can we probably look to, maybe manage these emotions and, what is it that we can look to do? So one is obviously it's, how we have to ask ourselves some big picture questions. That what is the time horizon for which I have made these investments? Is my investment horizon the same as what it was in the beginning? Do I have enough diversification within the portfolios? Okay. Is my portfolio aligned to my risk tolerance? And has my financial situation changed? Okay. I think it's important that we ask ourselves these questions. And these questions itself will give you answers to see to it that, okay, do I really need to panic and do anything as far as my portfolio is concerned? Okay. If your investment is anyway from a long-term point of view, short-term volatility doesn't matter as long as you keep, staying focused and staying invested for that period of time. which the Dalabar study very clearly says that the return differential has only happened because probably we did something which was not meant to be. If your financial situation continues to be the way it is, most of you all are salaried class people, uh, professionals, touch wood, doing well in your respective careers. I'm sure every year there is some kind of consistency as far as revenue stream is concerned. There must be some salary increases that would be coming your way. So if those situations haven't changed, obviously diversification plays a lot. As long as there is no excessive risk in a particular asset class or in a particular sectoral kind of a product, and the portfolio is aligned to take care of risk, means the portfolio is built in a manner that whatever may happen in the short term, over a reasonable period of time, you can look at returns that can get built out of that. Second thing, obviously, is at the end of the day, we all plan for the long term. Now, many a times, what it could, you could have short-term goals, you could have long-term goals. In the short term, when someone is coming into the workforce for the first time, his criteria could be that, okay, next 2, 3 years, I want to buy myself a motorcycle, I want to buy a car. He could look at investing from that perspective. But whenever we plan our investment decisions, we generally tend to break them into three main buckets: the short term, the medium term, and obviously the long term. Short term, as I mentioned, could be someone who's just joined the workforce and is there are aspirations that, okay, I want to buy that motorcycle in the first 3 years of my working career, or I like that nice watch, and I want to own that watch, or I want to buy a nice pen for myself. Medium term could be when you're probably just looking at buying a car, or probably thinking about settling down in life, looking at probably owning a home or something like that. And obviously, you tend to then start planning for just not your retirement, in general wealth creation, if you have kids, for their wedding, for their education. So these also are important aspects which will help us keep our emotions in mind. That if the investments are being done keeping some goals in mind, then let those goals fructify. Don't take a decision in the middle. Uh, the other one thing which we keep doing is, please don't keep checking our portfolios, too often. I know there is a lot of transparency today in the mutual fund industry. NAVs are declared every day. There are websites where all of these information, money control, you can upload your portfolio and keep tracking it on a daily basis. I don't think it's going to do any value to you. It just unnecessarily, if there is volatility, it just unnecessarily causes stress. The chances are there that at that spur of the moment, we may end up taking the wrong decision. And the purpose for which we are investing, or the purpose for which we are planning our long-term goals, they could get hampered because of probably doing something like this. uh, Today as humans, I mean, why do we have to keep checking our portfolio so often? I doubt it any one of us has a BP machine in our office ke we keep, strapping ourselves every 2 hours to check that acha mera BP control mein hai ke nahi hai. I don't think we do any of those kind of things. So portfolio ko chalte rehne do. Why unnecessary keep, looking at it on a more regular basis? The most important thing, obviously, is that you have to stick to your investment plans. It is important that if there is a purpose for which investments are being done, you have to allow it to play out. And I'm sure many of you all have been, in the investment journey for a reasonable period of time. And I'm sure many of you all do agree with this thing that, okay, fine, if you allow it to keep growing at a serious point, I think it helps. Like there is this one saying that some of the most wealthiest investors in the one are the people who are dead, because वो बेचारे portfolio पे कुछ कर ही नहीं पाए. And in fact, there are these classic stories about, like under the Enemies Property Act, there is this one particular family who owned, shares of Wipro. And, and basically that family during the partition ended up going to Pakistan. Their kids, this is this family by the name of Abu Bachar Cochinwala. Their kids became American citizens, and they came back to India and put a case against the government saying that my forefathers had shares of Wipro, and now we are the rightful owner, and they are in your custody under Enemy Property Act. They need to be given back to us. And this case happened, this article appeared in Business Standard, if I'm not mistaken, around 2014-15. And mind you, friends, that 10,000 rupees worth of Wipro shares, which the forefathers had owned, during independence, and because it was probably locked under that MDME Property Act, this gentleman came down from America to stake claim and fight for it, because at that point of time they were worth about 770 crores. Now, that is basically, the kind of wealth creation that got generated over this period of time. See, look at, like, obviously, the first chart I showed you was in the last 1 year, 128 times negative returns on Nifty, 118 times positive returns on Nifty. So if you look at the graph for a short period of time, you saw very, very strong volatility, like there were bips, like, which were there. But when you pull that line over long periods of time, that volatility actually ends up looking like one straight line. If you look at this graph, if you see almost 40 years, as far as the index is concerned, almost 15.8% CAGR. If you look at 30 years, almost 16 times high. If you look at 20 years, it's almost up almost about 18 times. Now, in this period of time, definitely there has been volatility. In, like, if I was to look at 30 years data or 40 years data, what all we haven't experienced as a market. We've probably seen elections, we've seen wars, we've seen global financial crisis, we've seen COVID, we've seen so many situations around. But when you look at, but this is the beauty. The first chart I showed you was like a up and down line. This chart, if you see over such a long periods of time, those volatile numbers are looking like one very clean, smooth line, which has happened during that period of time. Now, it's important, like, that why the long term. Now, I'm just giving you some examples. Like, okay, if you were to, like, if you look at Maruti, now Maruti had actually in September of 2007 had, come out with an IPO, and any 5,000 rupees in 5 lakh rupees invested in 2007 in the IPO has actually become 44 lakhs by September 22. So someone, I mean, if you had put 5 lakh rupees at that point of time, which could have got you a Swift or a car or a Maruti 800, today could have made you buy an Audi car. That's the kind of power of wealth creation that we've seen, which happens over a period of time. And these are such kind of companies that mutual funds typically tend to buy in their portfolios, and which sort of creates wealth over a period of time. If you look at like this company, which makes Royal Enfield bikes. Now, in 2007, if 1 lakh rupees was invested in Aisha, in September 2022, that basically has become almost about a little shade less than 1 crore rupees. So this is just some examples of how Indian companies typically tend to create wealth over a long periods of time. Third is basically like a company called Asian Paints, and many of us get our homes painted, and I'm sure many of us have used Asian Paints products. Now, 2 lakh rupees invested in 2002 has actually become almost about 3 crore plus by September of 22. It's almost 192 times in 20 years. So that's the power. Now, I'm sure some of us may have, invested during this journey, but I don't think so. We've seen the full benefit of that. I can actually talk about Maruti. I had invested in the IPO, okay, but I sold it in within 7 to 8 months of the listing. And no doubt, I was very happy at that point of time. But पैसे की जरूरत थी, बिल्कुल नहीं थी, but कर दिया जो करना था. Now, if in whatever limited I had invested as a retail investor, I could have also probably seen this benefit over such periods of time. So this is basically just an example to tell you that, good companies over reasonable long periods of time have been wealth creators from an Indian market point of view. The important thing is that, it's obviously good to stay informed, but we have to avoid taking actions on that. Like, I'm sure if many of us, maybe just think about the newspaper headlines which appeared in 2020 during the COVID. Every newspaper headlines and articles only spoke about obviously doomsday, that the world is coming to end, markets are over, and we don't know what's going to happen. Now, at that point of time, I think our emotions probably took the best of many of us. And while some of us probably were strong enough to, weather the storm, I'm sure many investors at that point of time took a call to say that, no, I have this portfolio definitely needs some kind of action. Just giving you some examples of our own Kotak schemes. So if like blue chip, which is a large cap fund, in April 19, like if you see the 1 year return of the fund was roughly about 10.7%. In April 20, the return turned negative, almost 20%. But if someone had continued to stay invested in this particular fund, the return in 1 year actually has almost doubled to almost for 50%. Now, some of you we have could have weathered the storm, but some people who probably in April 2020 took portfolio actions have permanently taken a loss or permanently booked their losses on the portfolio. Similarly, if we were to take another product of ours, which is equity opportunities, like a return for 1 year as of April 19 was about 12%. 2020 return became negative 16%. But in April 21, that same returns were up almost about 50%. And there are multiple products, but and this is just I'm just giving you examples of Kotak schemes. But the fact of the matter is this was the case with every possible mutual fund as far as in India is concerned. There's another example I would like to give you at that point of time, which Nilesh Shah has shared with us. In the month of April, May, he got a call from his family doctor. And his family doctor said that, markets are volatile, my portfolio is at a loss, and I'm not able to, मेरे को चैन की नींद नहीं मिल रही, I'm not able to sleep well. And all he just told them was that you're a doctor, you are a professional, there is a stream of income. And this is not the time probably to take any action on their portfolio. We probably are at the bottom. Let's wait it out and then decide what to be done. He on his own decided to redeem his entire mutual fund portfolio and ended up putting all that money in a fixed deposit of a bank. At that point of time, 1 year deposits or something were available in the range of 6 to 8%. By June, July, August, the same doctor called back again to say that I'm still having sleepless nights because the FD return that I'm going to get in 1 year is what the Nifty has returned in 2 months. What do I do? So we really and I'm sure many of us know people who at that point of time, maybe out of fear, have taken such actions and then probably came back again to the market, but obviously at a higher valuation. Second, most important thing is never attempt to time the market. Believe me, nobody, at least that I know of, can claim that I have been able to manage my entry and exits in the market very well. It is very difficult. We always say that the time in the market is more essential than timing the market. We are not gods. I don't think so. The experts are also able to predict that when the markets will go up or when they will come down. And performance of the market is not the same. So you have to manage, never ever look at timing the market. I think we have to keep our goals very, very clear and keep ensuring that we continue on our investment journey so that we are able to fulfill our dreams that we have built for the long term. This is fact about the Sensex. This data is from 1991 till about September 22. The Sensex has compounded at about 14.94%. Okay, there are 23 days when the Sensex has hit a 6, that is more than a 6% daily return. There are only 98 days when the Sensex has hit a 4, that is more than 4. There are these 65 days is where you have made most of your returns out of this 7,700 days. If you had missed these 65 days, your return on your investment is actually 0. Now, which are those 65 days? मुझे भी नहीं पता, सौरभ भाई को भी नहीं पता, and हमें आपको I am sure nobody out of all of you all know with these. But if you had stayed invested for this period of time, you have compounded your money at a little less than 15%. So that's why it's very, very important that, time in the market is more important than timing the market. Another example, like, which I like to just use is I'm sure all of us on this call believe that Sachin Tendulkar is probably one of the greatest batsmen, that we have seen. He scored almost about 16,000 runs, facing 30,000 balls. Now, if Sachin wanted, considering what caliber he had, he could have probably tried to hit every ball for a four or a six, but he never did that. What he always tried to do was to save his wicket. He's saying, if I'm on the pitch for a long period of time, I will be able to score runs. Depending upon the ball and the situation, he scored a four or a six. He took ones, he took twos, he took threes. These were the kind of, and he ensured that he wicket बचनी चाहिए. अगर wicket बचेगी, pitch पे रहूंगा, तो मैं definitely I will be able to achieve more of my milestones. And he took he faced 30,000 balls to score 16,000 runs. So obviously he also stuck around on the pitch. के डटे रहेंगे तो milestone achieve करेगा. हुक बॉल हर बॉल पे चौका छक्का मारने की कोशिश करेंगे तो डेफिनेटली विकेट चली जाएगी. Another thing obviously is, avoid herd behavior, what people around us are doing. I'm sure सौरभ भाई लास्ट एटलीस्ट एक साल में शायद क्रिप्टो रिलेटेड क्वेश्चंस आपके कम हो गए होंगे, but I'm sure 2020-21 में you must have been inundated with questions from investors saying that how can I look at investing in crypto?
True, 100%.
Yeah, and the fact of the matter remains is that, don't do something that everybody around you probably is claiming they are doing. Like I'm sure many of us have friends and relatives who may have come and suggested to us also saying that, Array, I made, triple digit returns by investing in cryptocurrencies and, those kind of things. I am very clear personally that जो समझ नहीं आता है वो करना ही नहीं चाहिए. Okay. And today, if I go back to those friends of mine who kept telling me in that, invest in crypto, when I asked them today that, Acha, have you made, what kind of returns have you made on crypto? Now, nobody has made returns on crypto. वो कर रहे थे trading, वो computer screen पे या अपने app पे, it was nice to see those kind of fictitious returns getting generated, but they were not realized returns. So, don't ever get into the herd behavior or that, that fear of FOMO, that the world is into crypto, main reh gaya. Nothing of that sort. It's just not needed to do. So, जो चीजें समझ नहीं आती है, I think it is better we don't get in. And the problem with FOMO is this is the way how our emotions behave. And this is, I think, a most common mistakes with a lot of us do. कि जब बाजार एकदम red hot होता है, that time we want to go and buy the stock or we want to invest in the markets. Then after that, markets come down. Chances are there that many of us want to average. फिर थोड़ा बाजार ऊपर जाता है, तो we say कि चलो ठीक है, I think we've taken the right decision. The markets keep coming down further. We start panicking that, I thought everything is looking hunky-dory. Why should I, the markets keep coming down further. Chances are there that we'll cut a loss and get out of it. Okay. Now, that is the time. Now, what happens is you stay out of the market. Suddenly, the market starts to take a U-turn. And you see it going up. Chances are our behavior is it could be a temporary blip. I'm sure it will correct. At that fall of the market, I'm sure Saurabh bhai, all mutual funds are coming and telling you कि sir बाजार काफी गिर गया है, ये time पे तो अपने को entry करनी चाहिए. Chances are that our tendency would have been to say कि no, I have already cut my losses. I think it will fall further. We will enter later. And the market takes a U-turn. And we keep looking. And this is exactly the kind of situation we probably saw between April, May, June of 2020. And many of us have not been able to catch that opportunity. And if I just purely go by the data of mutual funds, I think a large part of the investors actually started to come back again into investment mode only in November, December of 2020, when the reasonable amount of rally had already happened. So, I think the mantra is very clear that none of us are experts. I think we have to keep, doing the very basic, very boring things. We have to keep regularly making investments. Uh, Today when any of us fall ill and we go to our doctor's prescription also basically says to take some number of tablets 2, 3 times a day for 3 days, 5 days, depending upon your ailment. And if you follow that practice regularly, we always recover. So it's important that we continue this practice of regular investment. There are obviously, multiple ways, strategies of investments. SIPs obviously has been one of the most prudent method of investing to iron out any kind of volatility, to keep that discipline amongst us that, every month we're making some investments or the other. Um, whose SIPs in COVID happened have seen the benefit also. At lower NAV, we added lots of more units to our account statements, and as the market, and that also has helped benefit because the returns that you have got generated is because of the new number of additional units you accumulated when especially the markets were down. And most important thing is the asset allocation and diversification. Today, why do we like enjoying when we go to a buffet with our family on Sundays? Because हम लोगों को इतनी variety मिलती है खाना खाने की. And अगर हम rather than eating a roti sabji or a dal chawal, when we get a wholesome meal of all of these things put together, our meal obviously is much more enjoyable. Our meals are that much more delicious. I think asset allocation is a very, very important tool that we should continue to practice from a diversification point of view. The other thing is, let's be truthful to ourselves that we are not experts. Okay, I'm sure a lot of you all represent are working in multiple industries. Some of you all might be part of IT, some of you all be probably part of FMCG, pharmacy, pharmaceutical companies. At the end of the day, we are domain specialists in what we know. We are not financial experts. That's the reality. I myself tell, I've spent almost 28 years in mutual fund industry, but मैं आज भी बोलता हूँ कि मैं specialist नहीं हूँ. मेरे को नहीं समझ आता ये सब market का. So, one thing we have to know is that let's accept this reality. And because we don't know if today there is any company, there is many times when I go to a social gathering, my cousins ask me, Kare, you're in the mutual fund. Ek do tip de de. And I always tell them that I will give you a tip today, but I don't think I'm going to meet you for till we don't meet at another social function. So I will give you a tip and go. What is the chance when do you have to sell? How are you going to know that about that? So I think we should just stick to our domain specialist, and you have to leave it to the specialist like Saurabh. Because at the end of the day, this is his full-time job. He knows what are the kind of different situations. So typically, just like in cricket, even today, Sachin Tendulkar, whenever he talks about his success, he always gives credit to his coach, which is Ramakant Achre, because he trained him to see to it that depending upon the field situation, depending upon the ball, how to navigate this particular thing. And that is what Saurabh's job is. Saurabh's job is to see to it that he takes care of your portfolios, iron out how to navigate the volatility, what to do as far as at the different situations of the market is concerned, how to behave at that point of time, when to add investments, when to probably slow down investments, how to manage your asset allocation. So it's very important that that we should leave this to our experts who can typically help us plan our investment goals properly, help us achieve our long-term goals. More importantly, give very unbiased views and research and help control our emotions. So I think this is a gist of in terms of what I wanted to tell. The last obviously is that there is this one experiment called the Joshua Bell experience. And Joshua Bell is a world-renowned violinist, and people pay thousands of dollars to see his programs, in the USA and the different parts of the world that he posts. So one particular newspaper in Washington, D.C. Did this experiment where they made him wear very, very plain, ordinary man-looking clothes, wearing a baseball cap, And he started to play his violin at a metro station in Washington. And he played for almost for about 1 hour, his best compositions. And in that period of 1 hour, there were only about 5 people who stood there to listen to his music. And 3 people spent more than 5 minutes or 10 minutes listening to them. Or I think 1 or 2 people basically acknowledged him and gave him some tip. So what it meant is that the same Joshua Bell, people are willing to spend thousands of dollars to listen to his concert. Uh, but the same Joshua Bell, when as a very ordinary man was playing violin on a railway station, nobody even cared to give attention to him. So my only humble submission to all of you all is that Saurabh, myself, we all don't treat us like Joshua Bell. We are here to give you Saurabh is here to give you all the right kind of suggestions and advice on his portfolio. And I think it's important that the amount of research that he puts into on portfolios to come back to you in terms of suggesting and how to navigate you through these emotional times and volatile times. He definitely gets credit of it. So like the last thing before I finish that, so obviously Gandhi ji ke teen bandar hai, बुरा मत देखो, बुरा मत बोलो, बुरा मत सुनो. We are just converting the Gandhiji's 3 bundles to saying no daily sensex, no hype and noise, no tips, long-term investments, regular investments, and asset allocation. This should be the mantra for wealth creation over a long period of time. Just the last slide in terms of why invest at Kotak. We are a firm believer that we want to manage your trust first and your money later. At the end of the day, our business is all about partnership. This is not a professional relationship of a manufacturer and a distributor and a client. At the end of the day, we're all together in this journey. At the end of the day, what we have to look to generate is risk-adjusted returns. That the returns which are in line with the markets to outperform them, but without not obviously taking excessive risk. A very disciplined approach, and we'll be always available 24/7. Myself, Sachin, Mohit, my entire team, and Saurabh for any questions and queries that you have. So that's all at my end. Thank you, friends, and thank you for taking time out of your schedule for giving me this opportunity to talk to all of you.
Thank you, Manish bhai. Thank you all. Thank you for that. Short, very crisp, and very, very powerful, I would say, presentation. So the key takeaways which I have actually noted down is definitely we should not check or maybe look at our portfolio on daily basis. And again, we should link our financial goals with our investments so that whenever we take decisions, let's say to come out or to come in, basically we align those investments with our financial goals. That will help us not to get biased with what all, let's say, ups and downs keeps coming in. So what all hypes are there sometimes, maybe, maybe for any product or maybe, during any situation, let's say. So just take informed decision, never time the market. I think this is something which we have learned in last 7 years, and that's what, we keep regularly advising. As you rightly said that, if anybody would have missed those 65 days, probably his return would have been 0 or nil. So that really makes sense for all of us that, time in the market is more important than timing the market. Definitely avoiding herd mentality. Let's not do what others are doing, rather stick to your own financial plans. Even if you are okay to take a risk, let's say in asset like crypto and all, identify a risk, maybe 5%, you are okay to lose that money, invest, but don't just get carried away, maybe, which let's say, beyond which, your risk appetite just blast or something like that happens. So friends, I'll request all of you to please, maybe, you can just raise your hands if you want to talk to Manish and ask question, or maybe you can put your questions in the chat box. So once you raise your hands, we'll just unmute you one by one, and, you can put forward your questions, and you can also type in the chat box. We'll be happy to take it for you. Manish bhai, I'll just read some of the questions, which are coming, and I'll be happy if you could just answer them. Diversification is important. Then why some of the fund houses comes with so many types of fund? So I think Manish is the perfect answer. He is the national sales head. So I think, sir, you have caught the right person
Yeah.
behind this.
No, so see, if you look at from a mutual fund perspective, at the end of the day, broadly, if you look at it, the asset class, there are two broad asset classes that one can have. One is the debt funds, and one obviously is the equity fund. Now, equity investment is a very generic term, but it is within that, if you see, there are a lot of, companies which come across with various market capitalization, which the regulator has said that the first 100 companies are the large cap companies or the very big companies. Then the next are the mid caps, and then subsequent are small caps. Now, it would be wrong on part of the mutual fund to assume that if all investors in India are okay to invest in equity fund, so सबके लिए एक ही, it's like one size fits all is the kind of formula that should be there. It's not necessary. Today, first of all, investor is taking many investors perceive that investing in equity itself is such a risky thing. Then within that, the least I can look to do is depending upon risk taking ability of the investor, at least segment or what the regulator has done is basically come up with classification of schemes. So depending upon the within equity risk taking ability of the investor, one can probably look at. So that is where the diversification within equity fund house, within equity schemes or within debt schemes comes into play, because that can will also help you sort of de-risk yourself to that extent within that asset class.
Perfect. Rishabh has one question. Manish, what is the best way to invest in gold, silver, equity, and global markets? That's the best way to diversify, or you would suggest any more asset classes?
So I think international as well as gold and silver, all of that in a customer's portfolio, we believe maybe 5 to 10% maximum could be a good kind of allocation. There are many fund of fund schemes which are available in India today, which gives you exposure to international funds. And I think a lot of the funds are currently which are more US centric. So one could probably look at taking exposure into those kind of products through such fund of fund schemes. As far as gold is concerned, we always believe that I think a gold fund of fund scheme and the mutual fund or a gold ETF are probably more prudent and better way of investing than probably looking at buying physical gold in any form. But mind you, friends, there is one risk in gold that we have to keep in mind is there is an import duty which is eligible in India. So if you buy gold in say Middle East, which is 100 rupees, in India that gold actually is 112.5. Now, for some reason, if the government in the future decides to abolish import duty, chances are that you will see that at least a 12 rupee 50 paisa loss on your gold investments over here because of this import duty. But nevertheless, I think gold funds and gold fund of funds or ETFs are probably a more better source of or more medium mode of investing rather than probably looking at physical.
Ame has one question after this recent change on indexation, like, you will not get indexation benefit, let's say on international fund, on debt mutual funds. So do you feel, let's say maybe, debt mutual funds are better, or maybe, they can move to FDs, because again, FDs don't have that volatility. Sometimes debt mutual funds have that volatility when interest rate moves up and down. Or you would suggest some alternative baskets, maybe PPF, and they should explore those sort of, because of the indexation benefit has now been taken away.
So, in fact, the day when this indexation thing happened, and no, I'm not denying the fact that it obviously did cause a lot of, volatility concerns and inquiries over there. But there was one AMFI study which has got done, which says that in the non-equity fund category, the percentage of investments which are beyond 2 years, okay, was not more than 29%. Okay, so what has happened on the fixed income side? Yes, no doubt, a lot of money typically are have always, while they come with the purpose of 3 years, but they typically tend to remain for the shorter end. See, today what is happening is that fixed because credit is growing, banks are desperately looking to raise money in the form of current accounts, savings accounts, and fixed deposits. FD rates definitely are very attractive at this point of time. But if I keep that, and if I'm not mistaken, if I put a money in 5-year FD, every year that I accrue, I think I have to pay tax on that. if I'm not mistaken. In a mutual fund, even if you invest for a 5 year kind of a period, even in the new environment, your tax incidence will only come up in the year when you redeem. Till then, you really don't have to pay any tax. Okay. Second thing is you're locking yourself at a yield, which is today prevalent. Whereas as far as the mutual funds are concerned, the chances are the portfolios are mark to market. Now, we strongly believe that as far as the interest rate cycle in India is concerned, it probably seems to be almost coming to a peak of it. Even 2 days back in the RBI policy, the RBI governor himself has said that if inflation in India seems to be cooling off, they don't they did not feel the need to raise interest rates at least at this point of time. Now, if interest rate cycles were to turn from here and start lowering downwards, the mark-to-market benefit that you could, get in a fixed income portfolio and the holding return that you could probably generate in a fixed income fund will probably be far, far more than the fixed deposit rates that you're looking at this point. So I think maybe at this juncture, fixed deposits, obviously, because rates being high, there will be some kind of diversification where investors may want to lock themselves at this yield. But I believe very strongly that maybe 1 year down the line, when interest rate cycle has turned around, and when people suddenly start seeing 1 year return, 2 year return, 3 year return of debt funds in double digits, you will have a lot of more inquiries where investors will say that maybe I should look at allocating money in fixed income. But again, don't come with the rear view. Let's look at the front windshield and take a call. And I think at this point of time, if one was to lock money in fixed income schemes, the return that they will generate will be much more than the FD rates of it.
Perfect. So Shreyansh has one question. Shreyansh, can you unmute?
Yes, yes.
Yeah, hi,
I have a
Shreyansh. Go ahead.
question. Hi, Saurav,
Hi.
and hi, Manish. I have a question regarding situation in last 1 month. I'm seeing the whole fluctuation in the market. So I'm just a newbie, so I'm not sure I'm getting the market actually. But I discussing with the Saurav, he's giving the suggestion to stay in the market. But my question is, when we invest in ELSS for 3 year, it will be locked. Okay, so that amount means it is beneficial or it should be means I'm worried about this market fluctuation. Is this that will affect that long duration
So Shreyas,
investment?
yeah. So Shreyas, when you're looking at investing in a tax saving product, as Saurabh would have suggested to you, it's obviously from a point of view from obviously is your tax saving perspective also. I mean that is one of your criteria. And typically, if we see this, when someone looks at equity as an investment, we always talk about long term, and when we mean long term, we look at an investment horizon of at least 3 years plus. The reason is because, as you said it right, last 1 year, obviously, there has been volatility in the market. But वही अगर आप 3 साल बाद देखोगे ना, तो शायद आपका return will be better. Now, that's the reason why it's important to invest in equity with a long term kind of a time horizon, so that you can iron out this volatility in the short end. Okay, and volatility will always remain. Okay, because at the end of the day, what is equity markets? What is equity? It is a representation of the economy. Okay, now short term may theek hai, in US is doing better, in inflation India mein pad raha hai. There could be multiple reasons because of which in the short term the markets are looking volatile. But in general, if someone was to say, okay, how is the economy looking 3 years down the line, 5 years down the line? Chances are 7, 8 out of 10 people we meet, they feel that the outlook is looking good. Now, if that's the kind of time horizon is important for the markets to play out. So don't look at this 1 year return, 1 year volatility to be nervous about it. At least be patient. Give this market at least give your investments at least 3-5 years before which you can take time. And looking at your picture, तू मुझे बहुत young लग रहा है. So you can take risk. Age is on your side, and at this age you can probably look to take risk in the market. So I think equity is something that you should probably continue to stay, but give it time. Give it at least 3 years plus. Anyways, in ELSS you will have to be invested for 3 years.
Perfect. Ajay has one question. So, is it right time to spend some lump sum money in Nifty 50 index fund, considering the correction which has happened? And also, RBI suggested a rate hike pause. So that means probably, maybe we can see some interest rate reversal by next year. So, is this good time, let's say, to top up their SIPs or to put, I would say, lump sum money in Nifty 50 at this point of time?
So I think I think you're definitely while but if you RBI has definitely looked at giving it a pause as far as the market is concerned. I think next 2-3 months you could still possibly see some little bit of volatility. Now this entire thing about how the monsoon is going to play out is another big concern from a market point of view. There are articles which are already appearing which claim that this year the monsoons may not be as great as the way it has been. So automatically that's a little negative sentiment because that could be inflationary by nature. My suggestion would be that whatever your lump sum investments are, I think you may just want to, keep the dry powder ready on days when you suddenly see that the market has corrected maybe 3-5%. Maybe that is the time when you could look at allocating your first installment of say 1/3 at that point of time. But continue your SIPs. I think that's the only way. And if you see the last 1 year, how Indian investors are behaving, I mean, they've matured a lot. So SIPs continue to grow every month and month. The months when the markets are down, I'm seeing lump sum also happening. And the months when the markets are high, the lump sum cut number is actually becoming smaller. So that is the way. So it's like SIP plus lump sum in the months when the markets are low, and SIP minus lump sum or minus redemption in the when the markets are high. So I think that's the way you can probably look at allocating your investments.
Perfect. Ravi has just asked time in the market. It means, Ravi, the time basically that you stays in the market with your investments. So I think you rightly said that you should give longer duration when it comes to equity, and definitely when it comes to short term, definitely you can have, let's say, in a safer product could be like, let's say, RDs, FDs, or debt mutual funds that you can explore. Okay, and Mr. Maiti is asking, how do you see the future to invest in index fund? Because let's say now, a lot of popularity is there within the index fund, active versus passive. So how would you like to, share your thoughts on that, Manish?
Yeah. So see, my belief is that if you see, index funds obviously have gained a lot of popularity in the Western world, especially US, because the markets have become very, very perfect over there. If you see India as a market today, I think we are still, there is still a lot of price arbitrage which is available. And if you see over periods of time, actively managed funds have been able to generate alpha over passive funds or index funds. In fact, Saurabh, I'm sure you will get this data to share with it. Last year, if you see, there are index funds which have underperformed the underlying index. Now, you may wonder that how can an index fund underperform an underlying index? Now, there are but couple of reasons to it. One obviously is basically the tracking error. So if the tracking error of an index fund is very, very high, then that is where the underperformance comes. Many people 3 years back said that at least the large cap mutual fund schemes, investors will be better off putting it in an index because, how can you generate alpha by investing only in the top 100 companies of India? But the fact of the matter is that, they have also been able to generate alpha over this period of time. I'll just go back to that slide where, I like which I used to just show you the kind of returns. Now, if we were to look at this is my mid cap fund, which is emerging equity. You look at the kind of, returns, like the benchmark index in 10 years generated about 15% return. The fund has generated about 19% return. Okay. This is the kind of alpha that actively managed funds have been able to generate over a period of time. In equity opportunities, 13%, the fund has generated about 15%. So what I'm just trying to get to is that I think ability to generate alpha amongst amongst mutual fund schemes in India still continues to remain. And I think one could probably looking at such actively managed funds rather than looking at index.
Perfect. Dipti has one question. What about entering market at the age of 54? So what would you advise, let's say, to people, let's say maybe they are at the age of, let's say, 50, 52, and now maybe, they wanted to enter the market, probably, maybe because of the financial situation, because many of them, they've end up paying EMIs till till age, till late 40s, and now they have surplus amount of money they wanted to put into equities. So what would be your advice to them, and what kind of funds specifically, they should stick to?
Yeah. So in fact, Dipti, I mean, just to let you know that we as Indians, we are not early starters as far as investments is concerned. There was a study which was conducted which said that Australians typically start investing at the age of 24, but an Indian actually becomes a serious investor only at the age of 32. Okay, because with the early formative part of his working career, a lot of us are sort of wanting to say अपनी aspirations पूरी करने में है, and touch wood, because maybe we also decide to start very late of an investments because somewhere job security over here is far more than what is in the other part of the world, and that's the reason why. And there's a very basic thumb rule which says that equity in your portfolio should be 100 minus your age. So I'm not trying to say that your equity in your portfolio for in your specific case should be 48%. Your starting investments for the first time, I think you should definitely look to take baby steps. There are mutual fund products today there where available where in the portfolio equity component typically doesn't go beyond 20%, 25%, 30%, those kind of level. So there are such hybrid products which are available today, which could be ideally suited for someone like you who's starting an investment journey. But one thing is for sure, that equity has to be there in our portfolios. Our skin in the game as far as equity is concerned is very important, because that is what will help us build portfolios and create wealth over long periods of time. Now, for someone like a Shreyas who's starting young, equity in his portfolio could be even 100%, because he has that ability to take risk. But for someone like you who's in that 50-55 bracket, I'm not trying to say that 40-45 should be your equity exposure, but start with baby steps. There are products that are available where which can give you equity exposures up to about 30-35%. But and it's never too late as far as the markets are concerned to enter markets. At the end of the day, inflation will always remain high in India. And today you are seeing fixed deposit rates which are higher. But in the past, we've seen that, the interest rates, when they are especially low, and if inflation remains high, with the, you're like inflation is eating into all your savings. You don't want to be in a situation like that. The only way to circumvent that, or to get or not be in that situation, is to invest at equities. Again, depending upon your risk abilities, since you're starting off fresh, there are products available where there'll be relatively lesser amount of equity in portfolios, but which will be able to generate you returns, which will be better than what fixed deposits are giving you at this point.
Perfect. So Manish, Siddharth, and Arvind has this similar kind of a question. Sorry, Sanjay. Like there's so many AMCs are available at this point of time. How to choose a mutual fund? So how about what are the two, three parameters? Maybe let's say benchmark what you showed that you should look at a benchmark. Let's say XYZ, you have selected three funds. Whether they have been able to beat the benchmark consistently, that is one thing. Maybe another parameters, other factors which one could choose while maybe cherry picking a mutual funds, because now the buffet or the basket is very large.
To see, definitely diversification across mutual funds is a must. Okay, because every mutual fund manager comes with its style. So I think first of all, like in terms of the pedigree of the fund house. Okay, in terms of like all of that matters a lot. Second thing, obviously performance, and more importantly, let's not look at point to point performance, because that never gives you the right indication. Now, like just to give you an example, a lot of investors who probably never consulted like someone like a Saurabh and felt that they can take investment decisions on their own. In 2021, majority of such investors, purely on the basis of performance, if they had taken investment decisions, then a lot of us would have gone and put our money in IT funds. Okay, because when you look at 1 year returns of 2020, 21, IT funds were all 100%. Now, if we had done that mistake, today your returns in IT funds would have been negative. Okay, so I think obviously I would say rather than point to point performance, it's important to see the consistency of performance. That okay, over a long period of time, as long as we're able to generate alpha over the underlying benchmark, I don't need to be the number one fund. But as long as at least if you see that okay, these products are typically top quartile performer with consistency, that matters. Second important thing where obviously Saurabh will play a very important role is to do portfolio evaluation and tell you that, okay, where is the return coming on? I mean, as I said, risk adjusted return. See, it's very important because I can generate you fantastic returns by buying a lot of stocks and companies where, which could be, which could be very good in the short term, but which could be very hurting as far as medium to long term is concerned. So it's important the amount of risk that one takes in the portfolio. What is the quality of companies? What kind of portfolio has been built? Is there excessive risk someone is taking in a particular sector or an industry? All of that matters. So these are your parameters that can help you decide that okay, which are the maybe the 3 or 4 different fund houses or schemes of fund houses that you may want to look at investing.
Perfect. So as Manish rightly said, one, we need to analyze whether the funds have been able to beat the benchmark consistently. Second, also looking at the portfolio-wise composition, whether the portfolio is spread across. It should not be, let's say, that 10, maybe the 10 funds that have 50% exposure to the entire portfolio, and also diversification at AMC level. That is again very, very important because as I rightly said, every fund manager, they have this own team, they have their own set of mindset. Sometimes it may does well, sometimes it may not as well. So the idea is that you also diversify at the AMC level and also at the fund level. That is very important. Rahul has one question. There is news for de-dollarization in India, already done rupee trade with few currencies. Do you think that India's story already there for GDP growth and index following the growth almost, let's say, 1x? So what's your view on that?
No, I think see, dollar will always remain a world currency. It is the largest economy, so one cannot rule out the fact that that by taking a decision like this, we'll be able to de-risk ourselves versus dollar. I think at the end of the day, it is the reserve currency of the world. It is just that it was just an ability which was there with certain trading partners where at this juncture, free movement of trade in dollar is not possible. And that's the reason why these kind of agreements. But this is very common across many countries. It's just not that we have done it for the first time. China has such kind of arrangements with African countries, with South American countries. But the reality is that the dollar dominance as far as the world is concerned, that will continue to prevail. So you cannot ignore, not that's the reality you have to be aware of.
Puneet has one question. Is EPF a good option? I would suggest it's one of the best options, Puneet. So the moment you start earning, I think you should pump your employee provident fund because this is one such asset which gives you 8% tax-free return, and that's equivalent to pre-tax return of 11%. So I think it's definitely a good product, and I think Manish would also agree along with.
Yeah. The only encouraging trend I've seen is that when I started my career in 1995, I mean, PPF account was the first thing that we did, and LIC policy was what made us. But at least today, I'm seeing a very different trend where a lot of the people joining the workforce first are actually starting with an SIP rather than doing an LIC.
So Abhishek has one question. What should be the ratio of investing within debt and equity? Let's say he's doing investments in EPF, PPF, and mutual funds. So let's make it a moderate. Let's say, I would presume that most of the investors don't want to be aggressive. They wanted to have a moderate sort of a portfolio. So what would be your advice that, okay, this much should be into debt, this much should be into equity, and maybe this much should be into gold and international fund? Just a basic, thumb rule as per your presumption.
If I was to add the EPF and all of that, that's also basically fixed income only.
Yes.
So I think, I mean, if 100 rupees, if that portion is assuming about 20, then out of the remaining 80, I think then equity, and again, depending upon his ability of risk, I think equity can easily be around 65, 70. That baki ka 10 that you keep, let it be for liquidity purposes. Because ETF, PPF, and all of those products are anyway long-term locked-in products. So you will not be able to withdraw that money. So maybe 5-10% of debt investments that you keep it for liquidity purposes. The balance can basically be in equity. And as I said, that gold, international, probably not more than 5 to 10% of the overall book.
So as you said, 50 to 60% into equities, 10% into gold and international fund, balance 30 would be into debt, being long-term debt, and also considering the emergency fund.
Yes.
So this would be, I would say, a very moderate sort of a portfolio, which will certainly generate double-digit return.
Yeah.
Okay. Naveen has one question. Okay, Naveen, I think yes, you are doing your SIP in the large, mid, small cap fund, additionally doing 5K in PPF and 10K in NPS. I think that's a good diversification. That is what we are talking about. You should be doing in your PPF, NPS. In fact, Nilesh Bhai has always been said that, also NPS is a good form of investment because the money gets locked in for a longer term and you get a compound interest. So yes, definitely PPF, NPS, combination of SIPs and diversification will certainly, I would say, make a decent sense in terms of diversification to your portfolio. I think, Kush, we have answered that question about mutual funds. Okay, Kashyap has one question, if we are, let's say, direct and regular. So many a times, this question comes whether to move to direct or stick to regular funds. So what would be your advice?
So, see, yeah, that's the reason why I gave that example of IT funds. At the end of the day, Saurabh, when we fall ill, why don't we not go on Google and put our symptoms and or ask ChatGPT to tell us what medicine can we have? He's clarifying by direct equity. I mean, investing in stocks.
Okay, shares. Okay. I thought maybe direct versus regular.
So Kashyap, see again, I am of the firm believer that I don't know, depending upon whether do you have time on your hand to do all of those kind of things. Because investing in direct stocks just by hearing a few tips here and there or what the experts come and tell on television in the morning, I don't think is the prudent way to do. And I covered it in that slide by saying that do we have enough time in our respective profession or in our businesses to take time out to study and research about companies, and then after that get to know everything about a company and then taking an informed decision of investing. Now you may probably argue saying that in your mutual fund portfolio in a large cap fund, you're also buying Reliance, you're also buying HDFC Bank, you're also buying SBI. वो तो मैं भी ले सकता हूँ. So why shouldn't I not buy these stocks? But the fact of the matter remains is that today, if I have 1 lakh rupees to invest, in 1 lakh rupees, how much can I own in terms of the percentage? The reason I chose mutual fund is because in that 1 lakh rupees, I'm getting diversification across various companies. Plus the fund manager internally is deciding, okay, do I have to increase my weight in a stock? Do I have to decrease my weight in a stock? Do I have to get out of a stock? Or do I need to add a new stock? So he probably understands those things. I'm not saying that, I'm not trying to discourage you that you should probably not look at direct equity, as you have mentioned in your chat that you do comprehensive research and decide to do that. Please go ahead and do it. But my suggestion to you would be that let that not be the core of your portfolio. So you split your equity component into two parts. One is the core of the portfolio, which is that boring mutual funds, SIP, lump sum, which Saurav is managing. Okay, so let him keep doing that for you. And you take some percentage out of that, which should be your satellite, which you are doing yourself by investing in stocks. And you dabble within that satellite part of it. And with that full confidence that either I will make returns on it, or I will even end up generating losses on it. So I'm perfectly to live with it. So I'm not saying, so as you have written yourself, that no, you seem to be having an understanding of equity stocks, you have been doing very strong research. Please go ahead and do it, but split your portfolio into two: the core of the portfolio, which is your mutual fund, SIPs, all of that, and then let this become your satellite. Then you can decide what percentage you want to split between core and satellite.
Perfect. Amy has one question now. Some funds have come with quantitative strategy, where let's say, you define, let's say, these are the quants or these are the maths, and based upon that, the portfolio will change. So do you suggest also, let's say, to have a SIP or let's say, in a quantitative mutual funds rather than, most where, it is based upon, let's say, fund manager's view or let's say, the biasness, etc.
So, sir, I am not too sure about if there have been any such strategies which have come up, where they're able to leverage on quants to that great extent. I mean, I think, like obviously, if you look at products like balance advantage fund and all, where based on the models, the models are giving you. Now, those are, I think, if someone is starting afresh and wants to like dip his toes into equity for the first time, those are very good products to come into. The models have obviously worked over a period of time and has even proven that in a rising market, it has been able to cut equity exposure. In a falling market, it has been able to increase equity exposure. And the objective of those products always is to see to it that they're able to generate about 1-2% more than fixed deposits. That's what their target is. So I think definitely one can look at balance advantage kind of products when someone is starting afresh and saying that, okay, can I start a lump sum? Definitely you can look at starting a lump sum.
Perfect. Jay has one question. How much SIP should I start? Let's say if I have a monthly income of 1 lakh. So usually what we say, Jay, 20% of your take home salary you should be investing. So I would advise you maybe at least 20,000 you should be investing per month, considering let's say you have also to invest in other products like your PPF, NPS, etc. So at least start with 20,000 and gradually you can scale it up, because that's what Robert Kiyosaki said in his book, that if you can invest 20% of your take home salary for next 10 to 15 years, you can actually create, I would say financial freedom for yourself. So at least basic threshold limit would be 20. And beyond that, it depends upon, let's say, your income, expenses, and what all other patterns, let's say you have your expenditure pattern. Any thoughts on that, Manish?
No, I think perfectly fine. So.
Perfect. Pranav has one question. He has a outstanding home loan of 30 lakhs where he pay a EMI of 35K and he's getting a rental income of 20K. Current value is around 80 lakhs. Does it make sense to sell the property and invest in different products? I think many a times people have this, question, but again, you have an emotional attachment to the property. You don't want to sell, but the rental incomes are roughly around 4-5%. So in fact, as an advisor also, Manish, many a times I feel, let's say, what to advise. Because again, selling a property, normally we would usually do in a distressed time. Rather, we won't do that. So what would be your advice out here?
So see, I think the point is that a lot of us don't treat real estate as part of our portfolio because we're very emotionally attached to that. But the fact of the matter remains is that I mean, if you have, as Saurav said, that 4-5% of rental yield which is coming today out of that property, I mean, you can probably look at continuing with that. I don't think you need to add any more real estate. Definitely, in with the current situation that you're probably in.
Perfect. Thanks. Balaji is just recommending maybe some good few books or sites which you can refer to understand the behavioral risk.
So I don't know very honestly, Balaji, of any such books or stuff like that. But let me research some and I'll share with Saurabh so that he can share it with you.
I think Psychology of Money is one good book which I think every investor should read. And that typically covers the understanding, the risk, the investments, and what mistakes usually we make during our investments and course of time. With a lot of examples it has. That's something, which we can study.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.